Now, as we've been reporting, as you heard from Susan, gold futures hit $1,000 an ounce for the first time in more than 6 months, and the fourth time in history. Our next guest says this won't last. Here with more is David Moore, commodity strategist at Commonwealth Bank of Australia. David, were you surprised?
Look, we had thought it quite likely or possible that gold might again test the $1,000 an ounce level, mainly because we have a situation where there are a number of competing influences on gold. In particular, though, at the moment, US dollar fragility has been a factor that has been pushing investors towards gold. So we had thought there was a possibility that gold could go to around, $1,000 an ounce. One of the points that we've been making, though, is that we don't expect gold to hold at those levels. We believe that the shift in investor preferences over the course of the coming year, and in particular, a decline in the safe haven demand for gold, will ultimately see gold move back lower.
What would it take for gold to get back to 1,000 and stay there?
I think the main factors that would assist gold in going higher would be further US dollar weakness, and we have seen in the past quite a strong relationship between movements in the US dollar and new movements in the gold price, and particularly periods of pronounced US dollar weakness. We've often seen investment flows towards gold. So if there was further pronounced US dollar weakness over the coming period, then I think that would certainly could provide temporary support to the gold price at higher levels.
David, where do you see gold prices headed for the rest of the year? What's your target price?
We're expecting the gold price to get back down to around $950 an ounce by the end of 2009. And I think the main reason for that is that with the international economy sort of moving towards a recovery path, I think the safe haven flows towards gold are likely to abate. I think inflation risks near term are also relatively well contained because of the existence of surplus capacity. The main factor supporting gold is the possibility of US dollar depreciation, but at the end of the day, I think that'll be of a relatively moderate magnitude. So for those reasons, I think we'll see gold price move lower. An important point regarding gold is that these price levels, really, jewelry fabrication demand for gold is very weak, and so you don't have that underlying fabrication demand supporting gold at current levels.
David, how about other base metals, the likes of zinc?
Look, I think in the, on a, say, 3 to 6 month view, we might see a correction lower in a lot of the base metal prices. My reading of the market is that they've moved to factor in international economic recovery relatively quickly, but the fundamentals underlying some of the metals remain quite weak. And in fact, for example, I suspect copper and zinc markets, for example, will be in surplus this year. Looking, say, towards the later part of 2010 and 2011, as international economic recovery becomes more secure, I think we'll see more upside potential in some of those base metal prices.
All right, David Moore, commodity strategist with Commonwealth Bank of Australia, joining us on the line.